D-Wave Quantum Computers. What is this company doing right here, right now? Are they going to ride all the waves of emotion? Or is it time to take the surf like Kelly Slater all the way to profitability in a few years' time? Well, you'll find out right here, right now on Barry Charles. In this episode, we're briefly going to discuss what the business is about. We're going to look at two positives and two negatives in terms of profitability and growth. We're going to look at where can they actually improve to make more money for this company going forward. And then we're going to do a stock analysis of this company. And if you stay right at the end of the video, I will give you the intrinsic value of this company right here, right now, and potential for the future. So if you like what you're seeing or like what you're hearing, remember to like and subscribe to the channel to make this world go crazy with the best financial YouTube channel on earth right here for you. Let's get to it on Barry Charles. Yes, D-Wave is leading the way in quantum physics coming to reality and quantum computers. Are they going to be the company that you need to invest in going into the future, where you come to the right place to find out? We're going to have a look at it right here, right now, and we're going to start off with D-Waves, what this company is all about. Ladies and gentlemen, this company is a specialized company in quantum computing, particularly known in the quantum annealing technology. Unlike general purpose quantum computers, which aims to solve a wide range of problems, D-Wave systems are designed to optimize complex problems such as logistics, AI, and financial modeling. Founded in 1999, D-Wave was the first company to sell a commercial quantum computer and continues to advance its technologies with the use of Advantage and the upcoming Advantage 2 system. D-Wave also offers cloud-based quantum computers services that are also can be revenue streams with quantum hardware going forward. So basically, this company uses quantum mechanics in their computers, which they call it qubits, compared to bits in regular classic computers like Microsoft and etc., Apple. Basically, the difference is this can solve more complex algorithm issues compared to a normal computer. So that's why people may look into this company. So that's just a little bit of what quantum is about. So it's pretty much about the computer system, but they also go into cloud computing and other forms and consulting you all the way through as you learn to use this in your everyday business. But can be high cost for the company to get it starting and rolling using their own staff, to continuously have to pay them to help the companies build, which is the question they have with a lot of these, with this sort of technology. So what is D-Wave doing right here, right now to improve the growth of profitability for their company? Well, we're going to first look at two positives, followed by two negatives, folks. So let's start with the number one positive out there for this company, is that they have been increasing their bookings in 2024. Very impressive over the last D-Wave in the last year. They have reported exceeding 23 million in bookings, up 120% on the previous year. Wow, wow, wow. If they can continue this and they can continue to raise prices over time, the company should be in profitability in the next few years if they can continue this. But it's not looking good so far. Number two, positive news though, diversification of revenue streaming. So D-Wave achieves its first selling of Advantage quantum computer system in Q4 2024. This is a milestone, a significant expansion of the company's revenue model from solely cloud-based services to include on-premise system sales, potentially opening new revenue streams. So that's potential to make them money going forward. But let's have a look on the other side, the negative side of this. What can D-Wave company help derail them in terms of growth and profitability? Well, one, and it's currently happening right now, is stagnant revenue despite the bookings. Despite impressive growth in bookings, D-Wave annual revenue was flat at 8.8 million from 2023 to 2024, was exactly the same, which just does not make sense at all. But so this disconnect suggests the challenges in converting bookings into actually real hard reality realized revenue has been, which can impact on financial stability, obviously. Um, with also net losses of 143 million and 31st for the year, which was from 82.7 million the year before. So it's not good if you're trying to convert yourself and a company into long-term financial stability and push towards profitability. So it's not helping them at all. So there's a little bit of work to be done in terms of that. So that's really what's not helping the company right here, right now, in terms of the future. So that was the number 2 one. So this is obviously a big concern for the company, but even though they're professional service in computing, um, adding to more spend. I mean, in terms of the companies, but they also have to spend money on the actual person being there as support for these companies. So it's not looking too good if you're trying to be on there. So it's a time to get out of here with D-Wave and forget about it, or is it time to surf like Kelly Slater? Because you certainly don't want to surf like me if you want to be on the D-Wave train to profitability. But will this actually happen? Well, what we're going to do right here, right now on the channel for you is a stock analysis of this company, hoping to give you the opportunity to make a lot of moolah out of this company, or maybe it's time to walk away. Not financial advice. Do your own research before you invest into any stock. So yes, we're going to do a stock analysis on D-Wave right now. So as previously mentioned, the company debuted in 1999, or opened its doors, but it only went public at the end of 2023, December 7th, at closing at $10.15 a share. Which after that, it crashed to nearly 40 cents, folks. Unbelievable, what, 90% drop, unbelievable. And then it's up to about $7.50 right now. So if you're on $10 and you sold anywhere between then, basically if you stayed in, you still be losing money. So, but if people keep buying the dip, or just brought in when it was low, congratulations to you, because you're doing well at the moment. But is the actual company's figures related to this price right now? Hell no. Let's have a look at it here, right now. The 52-week range, you went from $12 to 75 cents. That's just showing you this is a penny stock at the moment, folks. There's some work to be done here. Earnings per share minus 0.20. There's no dividend. There's no PE ratio. The short term, the shorts on this company, 19%. The shorting on this investment at the moment. Market cap of 2.2 billion. Revenue was, as I said previously, has peaked at 8.8 million from 8.8 million the last year, so not impressive at all. And the net loss continues to go up and up and up. So from 2020, it was 10 million net loss, now up to 143 million. That's more than 10x, folks. That is embarrassing, and this company needs to do something big. Even if we look at quarterly and look for some improvements, the revenue's up and down. 2.3 million in the last quarter, 1.9 million the quarter before, and 2.2 million. And then if you go to net loss, 86 million in the last quarter, folks, 22.7 million and 17.8 million. So why was that? Why did they lose all their money? Well, that's because their warranty liability went out of this world after they sold that Advantage computer system. And the warranty was big money, and that's why they lost a lot of money in that quarter. So not good. So a non-operating charge, so they don't get money back for that. That is very costly. What else is not good about D-Wave? Well, if we look at the return on invested capital, negative 243%. In terms of shares outstanding, 291 million, continues to increase. Not good for you as the investor. Free cash flow is negative 45 million. No good. But total assets have flown up to 199.9 million, which is very good. But total liabilities also gone up from 83.8 million to 157 million, so not so good. So for an investment, so far, there's not really much you could say about this company that really gets you excited. Obviously, if they can sell more computers and start to get to profitability, this is a chance. But now let's have a look at the intrinsic value potentially of this company. I use Graham's calculator, which is a basic calculator for you folks at home, using current share price, earnings per share, the growth rate, and the current bond yield to give you the intrinsic value. So I'm going to do a bear case, a base case, optimal case, extraordinary case, and out of this world case to try and make you some money. So yes, if we look at the bear case for this company, the stock price is $7.50 at time recording, at the current earnings per share of negative 0.2, at a 10% growth rate with the current bond yield, you're looking at a negative roughly $6 stock. Now, if we look at the base case and say it's just going to get to profitability at 0.01% at the same growth rate of 10%, you're looking at 30 cents. So you wouldn't want to buy. But if this company somehow gets the earnings per share of 0.5 at a 15%, then you're looking at $20 stock. And then you're going, wow, wow, wow. So if you think the future is there, you'll buy all day right now. But if you think it's going to go to extraordinary case and it goes to earnings per share of 1% and 20% for the end of time, you'd be buying all day too at $50 a share. Now, if you think the stock's going to take flight and go extraordinary, earnings per share of 3, a 25% growth rate, $183. So it's really one of those pie in the skies. It's high risk, high reward at the moment. I could not invest in it right now the way I invest. I have to wait for the see it to actually start going in the profitability consistently, and their net loss is going up and up and up, not down, down, down. Obviously, you can make more money, but you can also lose all your money too if you invest right now. So that's the risk you take when investing in a company at this time when it's still looking to grow. You could be waiting 10 years to get a return on the investment. I like to get an return on investment within a year easily, in terms of, and it's still long-term investing. So that's me on D-Wave, potentially a buy if you think the future's bright for them, if you're thinking they can get the profitability. It'll be a steal deal at the moment, but they're a long way from that, and probably about 3 years at least before they get to profitability from what I can see right now. But anyway, that's Barry Charles for this episode. Remember to like and subscribe to the channel, and I'll be back with another video soon.